Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com.
Greetings, Boris. It's great to have you back on the podcast. I always really enjoy our conversations.
Thanks for having me, and same here, actually. Again, great work to you and to the whole MacroHive team.
Great. No, thanks for that. Well, let's jump straight into it. I mean, there's a lot going on in the world at the moment. So maybe let's just kind of sort of benchmark ourselves a bit here. So, what's your thoughts on the global macro cycle right now?
Great. First, a very quick disclaimer that these are my personal views and in no way reflect the views of the institution that I work for, which is Goldman Sachs. So my views on the macro cycle are that we have been in a late cycle situation, and it's very hard to call the length of the late cycle. It's probably better to call it a mature cycle situation. And, I think there have been a couple of false signals or a couple of shocks that were about to trigger what we call a recession, a rapid easing of the labor market, if we can define recession in this way, but they didn't. They didn't mostly because of the evolution of policy post-Lehman and the way automatic stabilizers work. Policy was super effective to stabilize the shock in 2023. As such, once you stabilize the shock, the cycle can extend, but of course, there are headwinds and frictions, and I think we are in slightly different places among the main regions of global macro. I think starting from kind of the point of weakness, I would be most concerned about the growth in Asia, particularly what I see based on my metrics in terms of money dynamics and credit dynamics in China. Even though we have had pickup in velocity and some decoupling between money growth and nominal growth there, the type of deleveraging deflationary vortex that is happening, which I do not think is now only due to the property market, but also because corporates have become increasingly cash cows, mature companies that can generate cash flow without much investment.
So it sounds a bit like Japan,
lowering
like Japanization in some ways.
On steroids, I think. I think actually the scale, the size, the global impact could be much larger, right? Because obviously China is a larger economy and quite integrated in the global manufactured goods chain. And then again, as you mentioned, Japan, obviously one country which I always look at when I want to kind of feel the temperature of what's going on in China, because it has transparent and timely data, is Japan. And as we can see, Japanese growth has surprised meaningfully to the downside. Our surprise index actually is at, I think, it's all-time low for Japan. So I think that it is quite concerning in many ways, mostly because it's going to make it harder for BOJ to start a rate hiking cycle as long as the cyclical weakness is underway. And the way I can see the time relationship between the collapse of money and credit aggregates in China and the Western PMIs, I think the next 3 to 6 months will be challenging, not only for Japan, but also for Europe, right? So US is in a different place. I mean, obviously,
just on China, just one thing on China. Yeah. We've heard of these raft of policy measures over the last month or two. Some people have called it kind of real estate QE and all of these sorts of things. What's your thoughts on those?
Okay, so look, the Chinese policymakers had targeted long-term stability in a way that they have been trying to avoid large injections of liquidity or stimulus support. First, because already the fiscal side is quite extended. I if there is one example where repeated use of public balance sheet at some point can reach limits, I think China probably is a good example of that. The public balance sheet, and there I mean also local government and quasi-local government vehicles, as well as the central government, which is still not as high, but obviously the pace of growth of central government debt has been quite fast. So I think the public balance sheet is becoming, relatively large for large-scale stimulus. So I think also the shift of the growth focus from infrastructure, which has been excessed by, so to say, to more advanced technologies and investment in high tech, science, genetics is very good. But again, that is not going to preclude, the propagation of these weakening impulses to the global economy. Again, I do not have a negative view on China per se. What I mean is that the impulse of the Chinese supply for global support for global demand is likely to weaken over the next 3 to 6 months. Let's put it that way. So I'm just thinking about it in a global macro contribution. I mean, there are some amazing things happening in China, as you can see, economists writing about scientific development and so on, so on. So I think that these are two different things. Again, who apart from Japan can feel some weakness. Obviously, you have Europe, which generally is about 3 to 6 months, and as you can see, even over the last 6 to 9 months, actually, European export or Chinese imports from Europe have not slowed down. They're actually down 10% year on year. That 3% is a dollar effect, but still, down year on year on something that normally is growing 10%, 15% year on year is a big deviation from trend, right? And again, this puts Germany probably in a slightly more difficult place, apart from all the other challenges that Germany has experienced, right?
And actually, on that German-China trade relationship, do you think some of that's structural insofar as China's producing more cars now, Germany's, there's a shift in the relationship where in some ways China's industrial export market is now starting eating into Germany's?
Well, absolutely. I mean, China, as it goes up the value chain in terms of manufactured goods, is going to become more and more formidable competitor. And look, I mean, Germany still, I think, produces or sells around 6 million cars in China per year. It's a large number, and that's why Germany has been a bit more restrained or skeptical in terms of the tariff decisions on Chinese vehicles in Europe. I do think that we're talking about broader capital good exports, which the German Mittelstand obviously is a major player in those, which if they do slow and continue to slow down, this can be eventually more challenging. So that would be my main focus. So that means that eventually down the road, ECB might have to ease more than it's currently priced in. That's probably kind of the and then taking into consideration other things, including discussions about our star. US is obviously a different place because US has extremely well functioning automatic stabilizers. Anytime you see some slowdown in private demand, you see immediate widening in the deficit, and that is then smoothed quite the overall demand level is smoothed quite quickly. That happens. Just to give you an example, we had the FCI tightening in April with a bit of a quickie. Also, in March things slowed down. There was a downside surprise on a few numbers, and then there you go. In May. So after April, in May, it had some slowdown, and then the May fiscal deficit came at 360 billion, which is annualized about 15% of GDP. Right? It's a fairly large number, and it's 4% in annualized lower than than the
I mean, how does that stabilizer
average.
work exactly in the US? I mean, what part of the stabilizer is it? Like lower sort of tax take? Is it more some spending kicks in somewhere?
So absolutely, yeah. No. It's not spending based. It is actually revenue based. It's a revenue based stabilizer, right? So your expenditures are fixed, and to be honest, in all fairness, when you have a political debate, usually the political debate's about the level of spending. And in terms of level of spending, the US has not been particularly loose in terms of the changes from last year, right? So the 2024 was not a budget where, there was a big spending spree. No, not at all. But because, in emerging markets, it's different. In emerging markets, it is all in the deficit number. And if you get a boost in revenues because of, suppose in terms of the shock, then politicians can very easily adjust spending higher because they have more money and they keep target like benchmarking deficit, which makes consolidation in emerging markets more difficult. While in a country like US, you have a positive surprise, then your deficit should be improving. Now, the surprising thing in the last few years was that despite the inflation shock, obviously the deficit did not improve that much. It improved somewhat after the COVID, right? But there was no tightening to levels which you'll see when U.S. fiscal policy is tight, like the 90s and so on. So overall, there has been a trend of loosening of fiscal policy in a number of countries. It's a bigger differentiating factor between the economies, and it will define also trends in exchange rates and interest rates. I think at least initially, and of course we have seen that markets have become more nervous in respect to fiscal policy, elections, and what elections would mean for fiscal policy in the course of the past maybe couple of years, right? And I think obviously started with UK with some technical reasons why bond market volatility increased, but I do think that that actually, when I look at the three blocks again, China, Europe, and US, I would still say that US still looks the strongest. And there is only one thing that I want to mention, which is absolutely phenomenal. There is one time series which is part of our recession probability model, and it's been quite a good actually lead, and it is the net interest expense of U.S. non-financial corporates. How much money net between what they have of cash and what they pay on their debt, how much they have to pay, right? So every time the Fed hikes rates, since practically the 60s, that number goes up 10, 15% year on year, and even sometimes 20, and there is a recession. Every time the Fed cuts, this thing goes down 10, 20% when there is a recovery. Guess where this number is now? It's minus 40% year on year, minus 40%. So this is the
so even though the Fed has raised rates,
where
the net interest expense of corporates has actually gone down.
This is the first period where actually the average, on average, and a very important caveat, on average, U.S. corporates are benefiting from the mix of loose fiscal and tight monetary like never before. Okay, so this is phenomenal. Of course, the caveat is that it's not evenly distributed, that you get a small number of winners, obviously the tech companies, and you get the high net worth individuals that are excessively benefiting, I would say excessively, but extraordinarily benefiting. I think that this is actually a very strong Schumpeterian moment because when you think about creative destruction, you're practically taking resource from the old world capital intensive, highly levered part of the economy, and you're shifting resources to the new tech-based, low interest rate, actually cash rich, low debt knowledge economy, which has no depreciation, right? So
in some ways, it's actually the distribution, the skew in the distribution isn't necessarily a bad thing. You're saying it actually could be positive in the sense that it will shift resources from the old to the new.
Well, it's bad for the old. I mean, it depends which part of the economy you're in, right? As we can see today, there was an article in Bloomberg about rising mention of bankruptcy in the media, like media account, comparing that to credit spread. So definitely, we have I had this macro factor one on my practice code, which is called the solvency risk index, which basically is a combination between real rates and credit spreads. And the real problem happens when you have high real rates and wide credit spreads. Now, this in the last 20 years, there was only one such episode at about 4 standard deviations from the average, which was the 2007, like Q4 2007 until Lehman, right? So that was when you had a combination of high real rate and wide credit spread. This is absolutely toxic, and it leads to major problems. Now, at the moment, we have relatively high real rates, but actually credit spreads are quite tight. This index is like a 2 standard deviation plus. It's all at 4. And that's why I keep saying when people ask me about, how long will the equity bubble, or is it equity bubble? I don't know. Like, how long is the party going to last? And I say, look, if you can answer to me when credit spreads are going to start widening, then I'll tell you, I'll be able to kind of narrow the answer. But I think credit is in the driving seat. And of course, there's been a lot of allocation to credit when you look at, the amount of money that has gone towards credit strategies, credit funds. So, I wouldn't say that the market is not supported. The overall yield levels, especially after, thinking of the traumatic, super low interest rate period of the past decade before COVID, might still look attractive to people, right? But obviously now the risk is different. I think that actually, in terms of strategies, there is a real advantage now to invest with the specialists who would know which companies can benefit and which companies can really get hurt in these policies of tight.
And it sounds like you're on a relative basis much more positive on the US than say Europe and China. Does that then mean that you're positive, say, on the US dollar? Does that also mean that you think, say on the Fed, that at the very least they'll cut less than other central banks? Could they not cut this year, for example?
To be honest, I think that I think we are past the point of no cuts this year. In terms of macro signals and expectations, I think that eventually when the world starts slowing down, still U.S. will have some recourse to that. What I do not think is that can happen easily is to see rates in Europe down to like 0 or 1%. I think that is going to be much harder because of the automatic stabilizers that we mentioned, and because of the fact that if you lower probably rates to 2.5%, 3%, the credit constrained part of the economy is going to have a rebound, and the one that has benefited until now is unlikely to be to get much of a headwind. Yes, they're going to have less revenue, but it's not going to be taking revenue away from them, right? So I think that the Fed has phenomenal power in terms of positive transmission, or backstop or put, so to say, and that is why people pour money into U.S. risky assets. I think it's a very kind of clear relationship between the two. To the contrary, I think that in Europe, we do not have the same type of corporates with the same type of liquidity profile, which means that the R-star in Europe is likely to be lower than in US on a more permanent basis. Now, we have this discussion about R-star, right? And I want to mention one thing in respect to that. There is a huge inconsistency in the market between the probability of recession 2 years down the road, priced by the yield curve, 3-month, 10-year, 2 years down the road is 90% probability of recession at the current level of inversion, okay? At the same time, 2-year wing, 2.5 to 1 receiver spread, prices only 10% probability of recession. So how can that be? How can the curve price 90% probability of recession and the 2-year receiver spread, the 2-year wink, which is not even zero, it's not 1 to 0, right? I mean, 1 to 0 price is 5% probability, right? So, and when we discuss that discrepancy, obviously one explanation is habitat and the fact that real money want to buy duration as a hedge to the equities of their own. It's a risk parity argument, right? Not everybody can do receiver spreads. Luckily, because also not everybody can sell them. But at the same time, people come with the argument, well, also our star is a lot higher. So in the next easy cycle, the Fed is not going to cut that much. And, I care reasonably strong view that actually it is very hard for US to make arguments about the actual real long-term rate. But it is more straightforward to make arguments about what is the front-end real rate that is going to influence, supply-demand conditions. And I think that front-end real rate varies with the level of fiscal stimulus. So I am more in the camp of not permanently too high, not permanently too low, but variable. While in Europe, I think actually it is definitely lower than US.
And just to be clear on the probabilities, you were saying one was looking at the effect of kind of the cash market, the yield curve probability, and the other was looking at the options market probability. Yeah. So and that's why you're talking about different habitats. So real money investors would be using the yield curve that will reflect their view in some way, and then the options, not all players in the market would necessarily use that. So that you could actually have different pricing. It may not necessarily be consistent with each other.
I mean, if there was an arbitrage condition, I don't say that there is a clear arbitrage condition, but if there was an arbitrage condition, you would put steepeners and you would buy the receivers. That would be it's a double negative carry though. That's the problem, right? So it's a tricky bit. Once and when the Fed starts cutting this kind of economics changes, because then the negative carry is going to decline of steepeners, right? So that's the thing. But I think it's an interesting situation. To be honest, I have never seen such a large discrepancy in probability pricing of the same event by different segments of the same asset class.
Yeah, and I guess also credit spreads are so narrow as well. Stocks are trading. I mean, they're also assigning a low probability. So there's multiple different.
No, actually, credit spreads type now is actually high probability of recession on 2-year horizon.
On a 2-year, you're right. Yeah, actually, I was thinking more short term.
Because we're thinking about the forward.
Yeah.
Short term, no, but on 2-year, a tight credit spread is actually the other way around.
Yeah, that's fair. Yeah.
So I mean, the overall probability of recession across various segments. So equities are still very low altogether, right? The equity signal is below 10%. PMIs have declined because they've been weak for so long that the model says the PMIs have to go up. But the reality is that the real curve becomes still is so inverted that there is no cyclical optimism in the real curve, and the real curve is highly correlated to the business cycle, actually, both in Europe and in US. In order to expect a sustained pronounced recovery as we know it from a cyclical perspective, you need the real curve to steepen significantly. I'm talking about you need 200, 300 basis points steepening in the real curve. So there are some things which are different in those key metrics and relationships that we know over the last 20 years, and that actually it requires more humbleness and more caution rather than anything else.
Yeah. Now, earlier you mentioned elections and politics. I mean, maybe we could start with, I don't know if it's easier or not, the US elections, and then we can talk about the recent developments in Europe. So on the US side, let me sort of just present this case to you. When I speak to investors, a lot of them use the 2016 reference point, which is if Trump wins the election, polling is kind of skewing that way. But let's do scenarios here. If Trump wins the election, that's going to be bullish for the economy. He'll have some kind of fiscal stimulus, whether it's more tax cuts or something, deregulation, pro-business, stocks go up, bond yields go up, dollar goes up. That's the template people are using. And then Biden will be just business as usual in some ways. So, is that the right template to use, 2016? Or, are you seeing something different in terms of how this, these scenarios would play out?
Look, I mean, I personally I think that, with US is so important to the global development that the best assumption is that the past is not a great guide about the future, that you should look about the new and the different things. Because otherwise it would just be too easy, and we know that it's not easy. So, um, so I think that it's very important to analyze the initial conditions. And I personally think that market participants, at least on the kind of the fast money, or I think also on the smart money side, they have very high prior that Trump is going to win relative to what the political scientists say, what even the betting odds say, right? And I find this very interesting because when market participants have certain bias relative to some specialist opinions, right, or betting markets, there can be surprises. Again, honestly, I am quite even on my view. I'm quite agnostic on my view about the outcome, but I think that if there is any reason to believe or any evidence to believe that the chances are more even than what market participants believe, there can be some moves even before the elections, right? That's kind of how I see. And eventually, because look, as we get closer to the elections, we'll have obviously more opportunities to recalibrate our priors, right? And that recalibration, probably is going to start next week with the debates. I mean, the debates are obviously important part. We have in August the Democratic Convention. We have Trump's choice of a running mate. So there will be a lot of things that are going to come to the market. But at the end of the day, what I think is important is to understand a very serious constraint that is not only valid for US, it's valid for a number of countries. And it is that we might have overused the function of the public balance sheet as stabilizer. If China wants to teach us a lesson without teaching us explicitly a lesson, is that yes, you can achieve greatness by maxing out the public spending card, but then eventually you will have to consolidate, right? And when my children are asking me, so what is today's religion? Because there is always now this debate about religions, and it's a kind of a big divisive. And I say, look, there is only one religion in the world today. It is the religion of avoiding pain by all costs and all means. Everybody is trying to practice that religion across all political spectrums. So it is, but the reality is that in systems which are zero-sum game or near zero-sum game, it's very difficult to do that ad infinitum, right? You must have the perpetuum mobile or infinite resources to be able to do that. If you have constrained resources, it's just a question of resource allocation or intertemporal substitution, and then at some point you have to take some pain, right? And obviously, when you have children and you're teaching them things, you have to explain why certain things which are not fun need to be done, right? And I think when debt to GDP levels go up, there'll be things that we'll have to do that are not fun. And the question is how we're going to get the political will to do that, right? And whether the markets will have to play a role by higher volatility to send a message and so on. So these are all things that have happened in the past. There is nothing new about that, right? We have all read the stories about the bond vigilantes and so on.
I mean, in the case of the US, I mean, people often say, when will the US debt, when will we see a US debt crisis? And you've covered EM for a long time, so you know what EM crises look like. I mean, and so in your eyes, I mean, how do you think about answering a question like that?
I have a very strong view, actually, and okay. I think it's very simple. No, it's not very simple, but I have maybe a one-liner. that can give a pointer. Look, the real problem is market volatility. Okay, this is the real problem, because if volatility goes up, some people make a lot of money and some people lose a lot of money, and those people who lose a lot of money, they do not come back to the game, and then liquidity goes down, and then there is a problem, right? And I think that is why central bankers are the best economists we have. Let's put it this way. These are the wizards that have contributed tremendous. These are the unsung heroes of our time that have contributed tremendously to the prosperity of the world, and they understand very well that you have to do things to try to smooth and minimize volatility. The problem, though, is that, again, if you start getting to levels of debt where or if you have funding policy that start creating issues, that's a risk. But more importantly, I think it's really dangerous if your debt and debt overall debt and funding goes up when actual wealth is going down. So, for example, take US 10 years ago, marketable debt was around 14% of net worth of US households and commercial corporates. Now it's 17. Is that a big change? It's not a really big change. I mean, 14, 15%, it's like 2 points. Again, it's a safe asset. Now it's also a higher yielding asset. I don't think this is a drama. It's a risk. Yeah. But if you have some events that create a large decline in the net worth, which means, we need a situation of a large equity sell-off, housing prices go down and so on, right? And at the same time, you need to stabilize and your debt to GDP is already large. And then the debt as a percentage of the net worth increases sharply and it becomes more volatile, then it becomes very tricky, right? Because then it becomes a lot more problematic in terms of forward decisions. It can lead to bigger increases in the saving rate, right? Which makes it hard. So I think that you can envisage parameters of the system where extensive over-reliance of the way the system behaved in the past may be misleading about the future outcome, right? And I think that in emerging markets, you have exactly these problems. At times, it's just basically, first, the net worth of emerging markets is a lot smaller. Net worth of emerging markets around 140% of GDP. Net worth of development, I mean, U.S. household net worth 160 billion in last quarter. This is basically 160% of global GDP. It's massive, right? So U.S. is a tremendously wealthy economy, and as such, I do not think that the current level of U.S. debt is an issue, right? And Japan tells us that as long as the private sector assets go up together with the public sector debt, might not be also an issue over a long period of time, right? The question is when there is imbalance between the two. This is the risk. And in all fairness, I do not see any substantial changes in that respect. So I am not a kind of cataclysmically bearish about, but I do think that interest rate volatility in the long-dated interest rate can pick up and can be higher. And then the other argument that I think is very important is don't forget the power of the carry, right? If you have an upward sloping curve and you had 200-300 basis points of spread or 400 basis points of spread between your funding and your long-dated bond yield, this is a very powerful instrument to stabilize the market. So I do think that I do not foresee a kind of a major debt crisis, but I foresee higher volatility that is going to give some warning signals to policymakers.
Yeah. And now we haven't talked about the recent European election results. So what we saw there was a much, a fairly sort of large victory for the far right parties across Europe. Then we've had the surprise French election announcement as well, where Macron has called for an election. People now expect RN to win the elections there. So then you'll end up with the RN, the right-wing party, the far right, winning parliament there. So, why has there been this rise in the far right? And then does it mean anything for the macro space or markets?
Look, I think actually, again, the outlook for Europe is complicated. Europe has been under a number of shocks over last, I would say, I don't know, practically since 2016, so to say, right? And the rise of the anti-liberal or nationalist sentiments and views and political ideas has been uninterrupted. And I personally explained that with one very, straightforward argument. It is the rising information load and complexity, perceived complexity, is creating anxiety in a wider number of individuals. And even though metrics of well-being continue to actually slowly move higher, that well-being does not result in more happiness and in appreciation of the status quo. So I think the impact of social media and the exponential increase of information overwhelms the bandwidth of our consciousness, which has not evolved for that amount of information. I mean, I'm sure that today in a week, we are processing more bits of information than people will probably have processed over a millennia in the history. And then, the brain or the physiology of the brain, this is a slow moving process. Maybe 20 generations down the road, our kids will have brains like that will be able to, grandchildren, they'll be able to process infinitely parallel computing type of vehicle, but we are limited. And that anxiety, I think, is generating two things. Anxiety in the past always generated the need for religion, which is a simple answer that can explain the world without questioning its rationality or based in science, right? That's number one. So this is actually, I think, a great explanation why the far right is rising. So they have one simple answer: it's foreigners' fault for everything. In fact, if you look scientifically, immigration is positive for the economy. The most successful countries in the last, I don't know, I'd love to imagine, are the multicultural, multinational countries. And there is zero evidence that, a clean, one nation kind of simple, straightforward state can be in a much better place than a country that has opened itself to immigration. So I think that the message of the far right is obviously based on something which is not founded in reality, but it works because it appeals to an existential fear driven by complexity. The second thing which I find worrying is the lack of dialogue, and I think again social media has strong effects with this cultivation practically of listening only to those who like you and talking only to those who think the same. I think the culture of dialogue and debate, which is absolutely essential and foundational for democracy. The word parliament, bears that in its meaning. I think this is very concerning, and I think that everybody, like we as society, as responsible members, we have to. Everybody has a personal responsibility to foster a culture of dialogue. If we do not want to end up in more division, more conflict, and a much worse state that we are now, and that is valid in the first place. I'm not talking about international, because like if you have bad actors who do bad things, it's really hard to okay, let me listen. Let me listen to your argument. You want to come and kill some people, and I'm going to sit down and listen to you. It's not destroying the energy grid of a country and making millions of people not being able to to live. It's not the right thing that you can have a dialogue on. You need defense equipment for that, right? So it's not really reasonable or rational. I think the first thing is to start on a country by country basis, where I think, in a way, in France, this is what Macron actually wanted to achieve by surprising everybody and triggering the early elections, because obviously I think Macron's team is extremely savvy. Macron has been phenomenally good for France in terms of business in the economy. He relies on technology. He understands public opinion. He understands the political landscape. And I think on his behalf, obviously everybody says this is a gamble similar to Cameron's Brexit vote. I think that you can be passive and wait and take time, but sometimes if you throw a little shock, you can try to foster negotiation, you can foster debate, and you can try to foster agreement. The main issue is whether this environment of polarization is just not going to create a bimodal kind of distribution of the outcome that has zero chance of kind of bridging differences, right? So that's the issue. Eventually, look, again, referring probably to Nassim Taleb, who is one of the great practitioners of probabilistic wisdom to the real world and life. I think am I kind of doomsday pessimistic on Europe? No, I think actually I'm strong opponent of the concept of anti-fragility. I think that systems that are closed, that are stiff, that do not have embedded drive for change, are a lot more at risk from cataclysmic events than systems that are battered with a number of shocks and have to go through. Think about on the political side, Europe actually managed to survive one of the biggest energy shocks in a way that has surprised many, right? In a combination both of kind of saving and some stimulus. So I do think that adjustment is possible. Again, political will is very important for the European project. So I would be worried if you have most of the countries run by far right, and the dialogue and the integration in Europe kind of being put on hold. Again, I do not think that there is a case for disintegrating Europe, and everybody has seen the benefits of the joint currency and ECB QE. So it's in the back of the kind of the thinking of all those far right politicians who think they might take power, and of course that type of backstop they will all love to have, right? So I think that there is I think ECB, again, back to my praise to central bankers. I think that central banking is the institution that has allowed for the prosperity. I think this will continue to be the case.
Yeah, not many people in finance sing the praises of central banks. So it's good to hear somebody actually say that. Now, we haven't talked about AI yet. Obviously, there's the optimistic side of AI, that this AI is transformative to society and for the economy. Then there's the pessimistic story, which is that AI will take people's jobs, will reach AGI, it's going to wreak havoc, amongst everyone. How do you think about the whole AI revolution?
So on the optimistic side, I'm going to start with the optimistic side. So I think the main area in which I would love to see more progress actually is education. I think that in a number of countries, schools look like they looked like 200-300 years ago. Now, you may call that tradition and quality, but I think that actually it is more a replication of vices rather than anything else, because knowledge has become very dynamic and you need a new dynamic approach. Now, obviously, there are some countries like Finland, which are incredibly innovative, and they are achieving great results in their education system. I think we have to experiment. We have to do different things in different countries using AI in schools. But I personally think that an AI assistant that brings the child on a tailored basis based on the psychological profile of the child on a curiosity journey with math, with science, with everything that is factual, is phenomenally important. Of course, the schools will remain relevant. They are not irrelevant, but they will turn more, I think, places where we learn social skills, we learn charity, and we play sports. And I think that if we can restructure the education systems along those lines, the countries that do that are going to yield phenomenal results down the road. On the pessimistic side, look, I am mostly worried of application of AI for malicious purposes. This is like rogue countries, rogue agents in the global system who want to create chaos and disruption. Obviously, will get much more leverage because they will be able to achieve their bad goals with less resources. This is the key problem, right? And obviously, there is a number of people, I think, thinking about that whose job is to protect society. And I think these people have a lot of work to do. And I think it's a very important mission that they will have. On the job side, I'm quite humanitarian actually in that respect. I think that I strongly believe in the creative disruption, creative destruction. Sorry, in this case, it's probably creative disruption. Is probably the better term. I was literal and Freudian. I think that we have to go back to the Bomo effect. The very productive parts of the economy shrink to irrelevance. You're probably not too worried that agriculture employs only 1%, of workers and creates only 3% of global GDP. 200 years ago, if you put those numbers forward, people would think that you are totally out of your mind. So I do think that there will be many areas that have potential to shrink on a relative basis. The Bomo effect stipulates, though, is that the wages in the areas that shrink go up. That increase in wages brings up the wages in the less productive areas, making them bigger in the economy. That's why government, along the productivity shocks of the last 100 years, government has gone from 3% of GDP to 50% of GDP, right? So, and the question is, what if we automate government, right? And I'm sure that the economy is going to generate some form of activities. I think sports and competition probably are going to be, and entertainment is going to be remunerated a lot more. I am very skeptic to the ultimate use of AI in terms of art and creativity, including music, because even though you can mimic existing things, the human preference set is a random variable. And as we know, AI is not great on random walks. AI is a martingale process that can very well reflect the existing state of the world. But, apart from strategic behavior, when it's optimizing a linear function, like playing Go, it is not great with nonlinear problems. That's why in markets, we're going to still have to take, the human decision making due to our ability to manage risk, and I think that it's not so straightforward to apply martingale technologies to random walks. As such, on balance, I'm huge optimist of the utilization if we can muster up the right kind of vision and focus. And I think that again, US, a strong case for US leading the way. UK as well, I think is doing a lot to try to keep those academic hubs that have their kind of ecosystems created, doing well. So UK is up there. India, China is a formidable power already in that respect, right? And yeah, and then on the security side, that's why I think I think that there should be dialogue, there should be discussions of what is allowed and what.
Now, the final question I had for you on markets is: are we in a tech bubble, and how long will it last?
I mean, look, I think we have to go back to physics there, and the log periodicity universal exponent. Usually, before reversals, you have acceleration in volatility. And the reason of that is related to deployment of margin and the returns from margin. Excess confidence leads to excess margin taking. And in order to cover the margin, you need larger and larger moves. Otherwise, the house of cards gets around. So I don't think that we've seen that form of exponential acceleration yet. And when we see it, we are going to see positive correlation between VIX and upside moves. I think this is potentially an indicator to look at. Again, I would say liquidity changes in terms of the broader measures of liquidity, as well as the broader measure of liquidity is velocity of money. The narrower measures of liquidity are bank reserves. Liquidity changes related to that usually can be triggers, especially in the last 2 years. Equity investors have been quite sensitive. So I would say probably not yet, but there are a number of flags that we have to be attentive to.
No, that's great. I appreciate that. Now, just to round off our conversation, I do always like to ask you about books. Anything you've been reading that you wanted to flag, whether it's in markets or non-markets, fiction, non-fiction?
Well, it's actually non-markets. A couple of things I want to mention. One is there is a really good book on. It's called Vienna: How the City of Ideas Created the Modern World. I can't see it on this, but it's actually out at the moment. And I was born in Bulgaria. Vienna became my home in the 90s, and I've always been fascinated by the history of this place in terms of intellectual history. So if you're more interested to learn about the intellectual history of Vienna and how it affected science and knowledge in the 20th century, I think this is a great claim by Richard Cockett. It's Yale University Press. The other thing, the other book that I find very interesting is called Babel by R. Kuang. R. Kuang is a fascinating young writer, and she. Currently she's doing actually PhD at Yale. She's already had a line of like 5 or 6 books. Babel is a book about, it's a fiction, completely fictional book about a Chinese orphan that gets brought by an English professor and trained in Latin and Chinese and Greek, and in order to become superb translator. It's a book about language and power, which I think in a world that looks very Orwellian in many aspects. And George Orwell, obviously, the theme of language and power is very strongly represented in his work. I think it's a very good read of that in a fictional fantasy, almost fantasy way. It takes place in Oxford in the 18th century, so it's a bit like a period drama. And I think sensitive to language, especially if we want to navigate a political and social sphere that is very polarized, to have inclusive language that tries to build bridges rather than build walls, is a very, very important part of this culture of dialogue and debate that we want to foster within our societies. I think this is very important.
No, that's great. No, I appreciate that. Thanks for that, Boris. So just finally, what's the best way for people to follow you?
I think that's tricky because I obviously people in the markets can follow my work, which is published by Goldman. But I think these podcasts for you have been a good way to reach out to some people who are interested. And of course, then people occasionally they just reach out and they drop me a line, and that's the way. But obviously, we're all very busy, and we try to find efficient ways to communicate. But I would say via the publications that I occasionally do address.
Yeah. Okay. No, that's great. So thanks a lot, Boris. That was excellent. And, good luck with all of your work, and good luck with navigating these markets.
Thank you. Bye. Thank you, Bilal. Same to you. Bye.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.